All right. Hive Digital Technologies, symbol HIVE, or Hive on both the TSX Venture as well as the NASDAQ, is a growth-oriented technology stock in the emergent blockchain industry. The company's revenue is currently dominated by its Bitcoin mining activities, but it is also working in the high-performance compute, or HPC, space at this time. The stock is up 94% year-to-date, trading at 407 Canadian and $3 US, at roughly 360 million Canadian market cap, or 260 million US, but it is highly volatile. So by the time this release, that is completely wrong. So why am I really covering this? Well, Bitcoin-related stocks have seen a bit of a pickup in attention recently, as the Grayscale Bitcoin Trust, symbol GPTC, on the OTC won its lawsuit to convert its fund into an ETF. And the appeal date has passed. For the SEC appeal date has passed last week. So effectively, this just sets the way for a spot Bitcoin ETF in the US, which opens up Bitcoin as an investment to more investors, as some are restricted to certain things. And it obviously is normally the institutional, they're restricted to exchange-traded funds, etc., instead of buying the actual underlying. So it's really a decent time to look at, is there value in the space? So I will be focused on the Bitcoin operations, that is just the lion's share of the company's revenues at this time. But they have been dipping their toes into HPC since the Ethereum mining is no longer an option for use of its GPUs, and they've been also buying more GPUs as of recently. The company is expanding these operations in light of the AI boom, which requires a large amount of compute, specifically AI GPUs. But they've not really made an impact on the financials at this time, and they just invested in some more recently, so you might start to see it by the end of this calendar year, but even then, I don't think it's going to be a significant portion. So a quick run through of the basic structure of Bitcoin mining, as it confuses many people, but it's in fact very simple in how it really works financially. We're not going to really worry too much about the technical aspects, just more the financial aspects. So Bitcoin mining is done on application-specific integrated circuits, commonly known as ASICs, which are really just computing hardware built to be optimized for a specific application or algorithm, which in this case is the SHA-256 algorithm for Bitcoin. It's a general encryption algorithm. It's used for other things, but the most notable application of it is Bitcoin. So I will note, just as a side note, you can actually run it on anything practically, not just ASICs. You can run, there's been people who mined Bitcoin on the original Game Boy that was released in the late 80s, you can run it on a smart fridge, but obviously commercial and corporate entities are not doing it because it's not economical at all. So a quick look at a simplified structure for any corporate Bitcoin mining operation. There's really 3 requirements for mining: ASICs, which can be seen as a capital investment; electricity, which can be seen as an ongoing per unit increase; and then the building and location, which range from proper data centers to dedicated infrastructure to modified shipping containers, and it varies drastically on the organization. So marginal profit really is when Bitcoin received is valued at more than the electrical cost, and then overall profit is once the sum of the marginal profits cover the ASIC and the data center costs, and as well as any additional overhead, so your SG&A. For Bitcoin to actually, the Bitcoin that is actually received is really dependent on the percentage of hash rate, or the calculation that the miner contributes to the total network, which is constantly going up over time. It is quite variable. I'll throw up a quick picture in post to show how variable it is day to day. The exact number of Bitcoins that they will receive as well isn't exact percentage because it's probabilistic, but the numbers we're dealing with are generally large enough to where the percentage of hash rate is close enough to the actual Bitcoin received. So each Bitcoin block is mined every 10 minutes, and it has a subsidy, so a fee which you will receive of 6.25 Bitcoin, as well as fees that are paid by the users for the transactions. And the subsidy, which that 6.25 Bitcoin is right now, it's cut in half every about 4 years. It becomes a bit shorter than that, but 4 years for all intents and purposes, with the next halving being due around April 2024, which effectively cuts revenue in half for every single miner across the board, across all the network. Because the fees that are paid by the transaction is normally, at most, it's a few percentage. This last summer, you did see it go up to about 10 to 15%, but that was very short-lived. But you saw that make headlines because it was a big deal. So really, why am I explaining this before even touching on the company? The reason is risks. and what the company can actually control. They can't control the price of the ASICs, as they roughly correlate with the price of Bitcoin at the time and how efficient they are. They can influence but not control the price of electricity by selecting the region, building certain infrastructure. They can, of course, control the type of infrastructure, which influences efficiency, and most importantly, they are at the whim of the price of Bitcoin, which is extremely volatile, as you can see in the chart above. That's a 5-year chart, and it's ranged from about 6K to upwards of 68K, and there's a high of last year, or late 2021, so about 2 years ago now, of 68,000 to about a low of 16,000 over the past couple of years. So it's very, very, very volatile, to say the very least. So moving on to the actual company. Per its last monthly update, which most public Bitcoin mining companies release, so you generally actually have a good idea of their financials before they release, at least on the revenue side. So for the September, the company produced 259 Bitcoin at an average of 3.69 exahash per second, if including its GPU operations, which mine other cryptocurrencies at this time, and they're looking to convert those into using for their HPC compute. They produced 269.5 Bitcoin for the month and 806.5 Bitcoin for what will be their fiscal Q2 2024, assuming that the audit doesn't change it, or their end of quarter actually changes something, because you will see that. Normally it's not a big adjustment, but I've seen that many times for cryptocurrency miners where they do end up saying, oh, it overlapped a bit too much on this quarter for our calculations. It gets lowered by 10, it gets raised by 10. It's not uncommon to see. Unfortunately, unlike other miners, Hive doesn't release its costs in its monthly reports. Quite a few other ones do, which I always like to see, because then you get a more up-to-date financial as it's going. And it's obviously extremely volatile, so we want the most up-to-date information as possible. But assuming the costs are similar to the last quarter, it had 18.7 thousand costs per Bitcoin. So they are currently making profit on a per Bitcoin basis. But that's also an adjusted measure as well, which I will get into shortly. But assuming that they're in the same ballpark as this last quarter, it had an EBITDA of 2.9 million and 5.3 million when adjusted. So they are making profit right now, at least on these bases. I will note as well, depreciation for Bitcoin miners is relatively meaningless, which is why you'll see a big depreciation adjustment out, as the ASICs valuation, which is where this depreciation value is coming from, is more, it should more be looked at as a fair value, as you can sell these used ASICs at nearly the same price as the new ASIC, assuming it's in working condition. You do have some that obviously will break down, but that's a relatively low amount. So GAAP earnings per share aren't really a good metric. It's similar in how REITs, you don't really want to look at GAAP, but you should still consider it, and why you are looking at these adjustments. You really need to go into the details. But even the adjusted EBITDA, very volatile. 5.3 million last quarter, negative 1.4 the prior, negative 1.9, positive 22.3, positive 11. There's just no consistency quarter over quarter. Even after adjusting, they're adjusting on a lot of stuff, and it is still very, very volatile. I want to make that extremely clear. So moving to the balance sheet, the company has a net debt and leases position of about 30 million and is holding about 59.5 million in digital currencies, almost entirely Bitcoin. They have small amounts in, I think it was Ethereum Classic, which they're currently mining on their GPUs, but nothing substantial. So if they were to liquidate these digital assets, the company would have about a net cash position of 29.6 million. Not saying they will, but many other companies have, and you'll see that quickly come to the cash. So it's not an entire useless metric looking at net cash plus digital currencies, because it is a liquidative market. You could probably see it similar as a level 1 equity security that you'll see on a company's balance sheet, something like that, or a trading security, something in that manner. So moving on to valuation, which I specifically added a dozen asterisks to the adjusted EBITDA, EV EBITDA, as I'm specifically going to give them a generous adjustments to the generous, but to create a generous valuation to make a point. So first off, we use an adjusted enterprise value, which treats Bitcoin as cash, as I was saying before with net cash. It's not ridiculous, but it is abnormal, and it is extremely generous compared to a normal valuation. But looking at adjusted EBITDA is the problem. As I mentioned before, ASICs generally trade on their fair value, so depreciation doesn't mean much because the actual value doesn't follow the depreciation, and that's generally an issue with computers because they depreciate quite quick. So you have a very front-loaded depreciation expense, which doesn't match. So if you're buying a ton of compute or any data centers up, anything like that, it is depreciated quite quick, but that might not match the fair value. And that's a general issue with accounting, but it's specifically notable here. But the issue is their adjustment also removed the effects of impairment, which is meant to bring it to a closer to the fair value price. So they effectively removed the fair value consequences as well as the accounting consequences of a major cost. So it significantly inflates their adjusted EBITDA. And still, at that, the company is still trading at 9.4 times adjusted EBITDA of their adjusted enterprise value. Extremely generous, and that is still expensive. So if we were to compare it to trailing free cash flow, it's roughly 90 times. It has its own quirk to the metrics, but even then you can probably have a better idea that the company is extremely expensive at this time. So our take, to summarize the Bitcoin mining industry as a whole, is just you're really purchasing operationally leveraged Bitcoin, which results in higher equity volatility, but potentially higher returns than Bitcoin itself, which obviously traders love. But as a long-term investor, the risks are just astronomical. Hive is an extremely volatile in price and fundamentals, as they are industry price takers, and even under a generous valuation metric, the company is still expensive. So I'll open up to you guys if you guys have any comments at this time.
Yeah, I mean, it's interesting when you look at how the crypto mining or Bitcoin mining space works. Obviously, it's not just Bitcoin. There are other cryptos as well, like Ethereum, and each one works a little bit differently. But is it 21 million coins is actually Bitcoin is set up so that once it hits 21 million, there's not going to be any more coins. So nobody's going to be able to mine anything after that.
No,
right?
you can mine it. So they'd receive those fees, but they would, that's when the subsidy runs out. So the subsidies, effectively, you can see it as like a monetary policy with a set limit. So right now, I'll quickly bring it up. So right now there is, where are we? There is 19.5 million Bitcoin outstanding, and it goes to about, to hit that 100% supply, you're going out to February 8th, 2140.
Right.
But to get 95% supply, we're only in 2026. It significantly slows down because the subsidy is halved in every
last,
year.
as you said, every 4 years it halves. So even though we've got, 17 years before you can't mine Bitcoin anymore, as we get closer.
117 years.
Oh, so 117. Sorry.
Yeah. Until you no longer receive the subsidy.
Oh, so it's 2140.
Yes, 2140. Oh, that's how much the exponential. Yeah. 2040. Quickly.
This is it's halving next in April, right? It halves next in April.
Roughly. It's an estimate always whenever you see those dates. I don't know if you guys can see it here. I'll put it up more visible on the podcast, but you can see down here, this is just a dashboard for Bitcoin. Down here under future Bitcoin supply, where did it move it? So you'll see 95% by March 18th, 2026, 99 by 2035. But we're already at 93% total supply. Does really, if you think about the stock, does 7% dilution really change much of the valuation? No, it really doesn't. It might a bit, but it won't matter much. So like dilution for Bitcoin is more or less done. And the miners will still exist because they will still get their fees, which we can see somewhere up here. Right now, we're looking at a 2% fee to the total reward that they get, which includes the subsidy. So right now, fees, which they get from transactions, is only 2%. So if they were to receive the same amount of dollar value as they were now, when the subsidy removes, you would at least need a 50 times increase in value in Bitcoin. To give an idea.
50 times increase.
Yes, 50 times. So you'd be looking at a bit over $1 million a coin.
Bit over $1 million a coin. Interesting.
Kathy would love that.
I'm sure she would. And then Ethereum, just to kind of touch on Ethereum, because that's the second biggest crypto coin, right?
Yeah.
Mined differently. Now, they were going to change, or they did change the way that crypto is mined. They already did. And I had heard that was basically completely changed the profitability or what was in it for the miners. So is it still profitable then to mine?
You actually cannot mine what is known as Ethereum. So this happened last September. They switched to proof of stake, which is effectively how people can make money off of it now is they give it out for lending. Kind of, that's very oversimplified, but that's how you can see it. And they get about 4% interest, I think, on their staking. Versus
so
miners can no longer do
4% return on your assets. Is that?
Yeah, effectively that's what it is. Plus then the price change.
Okay.
Yeah.
So Ethereum as a mining currency now is
gone.
not really.
It's
it's a financing currency, right? Yeah. And then I don't know. I do remember looking at a breakdown of all the top coins, and once you get past, the 5th biggest coin, their market shares are pretty much negligible, right?
Yeah. So you can look at. I don't have it up. I'll put it up. But there's some people that use Bitcoin dominance metrics, and it's about 50% of the entire cryptocurrency market. But then a big subset of that is also stable coins, which are really just deposited U.S. currency for the most part. There's issues with them that I'm not going to go into right now.
Right,
but
right.
That's
it's a complicated space.
It is very
definitely
complicated.
A lot to know. Yeah,
for
but
sure.
You just really know Bitcoin's the majority of it at this time.
Yeah. I was actually just on YouTube last night and came across a Vice documentary about the OneCoin lady who's like supposedly coined herself as the crypto queen, where they ended up raising, I don't know.
I thought that was you, Brian.
Billions and billions. No. I wouldn't be on the podcast right now if that was me. But no, she ended up stealing billions and billions and then disappearing. Anyways, I saw the documentary and it's just like all I could think is these poor people who had no idea what they were investing in. Yeah, you got to feel bad for some people that are just trying to chase the hype, and that's how you're gonna end up.
Well, in one respect, yes, you have some empathy for people that get caught off guard, but on the other, I mean, if you're just gonna go
a fool and his money,
like how much do you if I put a mortgage on my house and then go to Vegas and throw it on the crap table and lose it. I mean, I wouldn't lose too much sleep for me because that's just not a wise thing to do. Right. So,
yeah, the fraud in the entire cryptocurrency space has a lot of aspects to it as well. I love personally diving into it. I know you guys watch.
Well, there's many examples that you can dive into, right? So,
Yeah. Like I even just saw one the other day about Logan Paul, where basically they were going to talk about, or they talked about this cryptocurrency on their podcast. And one of the co-hosts on the podcast were like, it sounds like you guys colluded to talk about this on the podcast.
Someone's watching CoffeeZilla, which I will
put in the description as well. And they're like, no, we didn't collude. There's literally a video afterwards that comes out of them colluding right before they go live. And making this podcast, basically saying we need to buy more of this coin. It's just, such a sleazy, So
they owned it ahead, and then they have millions of followers, and then people bought it and they dumped it,
and they dumped it. So it's like
it's probably a liquid, relatively speaking. Too.
Exactly.
It's impressive.
Like
should they not be in jail?
Well, and this is what CoffeeZilla, who I was listening to, and Brett saw the same video, is saying, is like arguing, these guys
I don't even think it's an argument, to be honest. But
well, it isn't. But why aren't they in jail?
Yeah,
that's the thing.
It's true.
So
it's true.
Well,
regulation typically takes 10 years to catch up at least. So maybe in 10 years somebody will prosecute.
By then,
and they'll get a slap on the
wrist. Completely.
Wrist.
Right. So
yeah.